Hey guys, hope you all can hear me. We're just getting started this evening. So today I didn't have anyone to join me on the stream. Still, working on getting some people involved, which there are some people I've been talking to, and hopefully they will get on in the next coming weeks, and that will be awesome. But today I wanted to talk a little bit about kind of, the overall stock market and what's going on with that. And then I also wanted to talk a little bit about, some of these income ETFs. I've kind of been looking at them a little bit over the past year or two, and then I think over the summer or maybe during the fall semester, I, looked at them a little bit more closely and was trying to actually come up with an idea of sort of which ones of them I thought were quote unquote the best. And so I kind of wanted to talk about those as well and just kind of talk about, their performances and dividend yields and stuff like that. So yeah, so right now, I guess we will just start with talking about the income ETFs. Hey, what's up, Ryan? So the first one I'm gonna be talking about is Devo. I will share my screen here and kind of show what we're doing and basically what these are about. So this one is Devo, and it has of all of them, its dividend yield is probably the lowest. It's right around 4.9%, as you can see down here, which for most dividend stocks that's a pretty good dividend yield. But the thing about Devo is that they kind of strategically sell covered calls, and they oftentimes will like buy them back for a profit, I think. And so in a very strong bull market, oftentimes, they're not going to lag the market quite as much, because normally most of these income ETFs, they're going to lag the market because they're kind of capping their upside by selling covered calls a lot of the times. And so Devo kind of tries to mitigate that by being a little bit more strategic and nuanced with their covered calls, and also definitely they're going to move down with the market, but ideally it won't be as much because they, have those covered calls. So those covered calls will basically make them money when the market goes down, which is a good thing. So if we look at their performance, they have that dividend yield of around 5%. And then over the past year, they're up about 12%, which is fairly good, I would say, because you got 12% plus the 4.9% dividend, that's 17% about. Year to date, they're down about 4.9%, which seems kind of bad, but as we'll look at in a second, that's really not that bad compared to some of these other income ETFs. Hey, what's up, Ryan? How's it going? Hope you're doing well. And let me know if you do have any questions, anyone. The next ETF we're actually going to talk about is JEPI, and I like this one a lot as well. Basically, it is similar to Devo, and then it sells covered calls, but it also has what are called exchange traded notes, I think, which are sort of similar to like a bond in that they provide sort of a fixed income. So some of this fund is allocated to, direct equities, in which they're, doing a similar strategy to Devo and selling covered calls. And some of the fund is allocated to those ETNs, and those are basically providing some downside protection, hopefully, while also boosting the income a little bit. So their dividend yield right now is 7.68%, definitely higher than Devo. And on the year, last year, they are up about 6.87%, which is a little bit less than Devo. But if we combine that 6.87% with the 7.68% dividend yield, then we're right around, if my math is right, about 14.5%. So that's compared to the 17% approximately of Devo. And then year to date, they're down about 6.22%, which is a little bit more than Devo, but definitely not as much as not as much as the overall market, and not as much as some of these other funds. Oh, Ryan asked about the T earnings. Honestly, maybe we'll take a look at that later, because I honestly did not, look at the T earnings at all. I noticed that they beat by maybe 2 cents. I think their earnings reported were like 78 cents, and the consensus estimate was maybe like 76 cents. Actually, we'll probably look at that after these income ETFs. So the next one we're going to look at is NUSI, and this one is from Nationwide, and it's supposed to offer downside protection, because with some of they basically sell covered calls, and they try to offer downside protection by buying puts with some of the premium that they receive from selling those covered calls. So they're not going to be able to provide, the quote unquote maximum amount of income, because they're taking some of that premium from the covered calls and using that to buy puts. But it will supposedly offer some downside protection in the event of some sort of market crash. So they have a dividend yield right around JEPI's of 7.6%, and performance over the past year is minus 8.48%. So they're really negative about 1% over the past year, and year to date they're down about 9.5%, which is right around in line with the S&P 500. We'll actually pull that up as well as a point of comparison. We can pull up SPY, and we will also pull up QQQ to just kind of compare to these income funds. So year to date, SPY is down about 8.75%, about the same amount as NUSI, and QQQ is down about 13.39. So NUSI is definitely down less than QQQ, but it's not really all that significant. I've heard some people talk. Jerry was saying, I think at some point, that the downside protection of NUSI is really in the event of a market crash. It's not really going to help much in just a little 5 or 10% pullback here and there, which sort of makes sense to me. But I also haven't really researched into exactly how they're buying puts, and how the value of those are going to move, relative to the overall market. And then the last one that we are going to look at, of course, is QILD. They have the highest dividend yield, right around 12% right now. And performance over the past year is minus 10.5%, so up about 1.5%, including dividends. And performance on the year is down about 9.64%, or on year to date, that is 9.64% down, which is not too bad. But The thing to keep in mind there is that they are based on the NASDAQ, and the NASDAQ is down about 13% year to date. So really not that bad. But also another thing I noticed is that QLD has been trading in this range around 2150 to 2250 pretty consistently, but they sort of seem to just kind of fall apart when there's more of like a market crash or correction, because they have these huge downward movements. Like in March 2020, they were down all the way around 16, 17, $18. And they, recovered quickly, but it really took them a long time. And it doesn't look like they ever got to the pre-pandemic high where, most companies and certainly the indexes, all the major indexes have way eclipsed their pre-pandemic highs. Like if we look at the QQQ on the weekly chart, this right here is the pre-pandemic high at 236, we'll call it. And right now they're at 344. So they're still way above that pre-pandemic high. Whereas QLD is still below the pre-pandemic high and dropped, close to a level that we haven't seen since, the beginning of that pandemic and the March 2020 crash. So that's something to keep in mind with QLD. It really seems to kind of fall apart a little bit when there's a little bit of a market pullback or market crash. So that kind of value of your underlying shares doesn't seem that stable. But I think, if you are just in it from the income, then maybe it's not that big of a deal because you're never really going to want to sell those shares. But at the same time, it is a little disheartening, at least, to see your shares decrease a lot in value. So we're probably going to try to look at the T earnings as well, because Ryan was asking about that. And, I did want to talk about like current news in the stock market. So we'll look at those earnings. Let me try to find them here. Let's see. Look up T Investor Relations. And then we'll try to find where they list the earnings. So they announced their fourth quarter and full year 2021 results. That's probably what we want. Okay, so I'm going to share my screen and just kind of show this to you, and my reaction to it, I guess, will be live, you could say. Not gonna know what's going on here. So we'll just kind of read through it together and see what it says. So fourth quarter and full year results. This was published today, January 26, 2022. Consolidated revenues for the fourth quarter of 41 billion. Reported EPS of 69 cents compared to negative 195 in the year ago quarter, which included non-cash charges. Adjusted EPS was 78 cents compared to 75 cents in the year ago quarter. I think, the consensus estimate for adjusted EPS was around 76 cents. So they did beat that by a little bit, which is good. Cash from operations of 11.3 billion and capex of 3.8 billion. They say gross capital investment of 4.9 billion and cash content spend of 4.6 billion. I'm not exactly sure what that means. Let's try to find the little one. Gross capital investment included capital expenditures and cash payments for vendor financing and excludes first net reimbursements in fourth quarter. Gross capital investment included 600 million in vendor financing payments and excluded 500 million in first net reimbursements. 2021 gross capital investment included 4.6 billion in vendor financing payments and excluded 500 million in first net reimbursement. In 2022, vendor financing payments are expected to be in the $4 billion range. So I'm not sure that was really very helpful, but capex again, like I said, was 3.8 billion, which leaves free cash flow of 8.7 billion dollars. Which, if we look at the dividend, I'll try to find. I'm not sure. They'll probably say something about dividends, and we can calculate that free cash flow payout ratio. But I'm not sure what the total amount they pay in dividends is. I'll have to look at that. But for the full year consolidated results, revenues $168.9 billion, and they had EPS of $2.76 compared to negative 75 cents in the prior year. Adjusted EPS of $3.40 compared to $3.18 in the prior year. So honestly, not too bad of a increase. Nothing crazy. Cash from operations of 42 billion, capex of 16.5 billion, which leaves free cash flow of 26.8 billion with a dividend payout ratio, free cash flow dividend payout ratio of 56%. I think they said they wanted the dividend payout ratio to be in the 45% range after the spinoff. I'm not positive on that one, but I think that's what they said. So interesting that they're a little bit higher there at 56%. That smells like tea to $5,000. I'm not sure about that one. Honestly, they did have a pretty rough day today. I think tea was down like 8%, which is pretty crazy. If we look here, tea, they were down, 8.4% just today. And I'm not really sure why they dropped so much. Let's just keep looking through the earnings, I guess, and see what we see. But let's see. Fourth quarter results showed continuing customer growth in wireless fiber and HBO Max. AT&T continued to lead the industry in postpaid phone net ads, gaining more subscribers than in the prior 10 years combined, added more than 1 million fiber subscribers the fourth consecutive year, which it has added 1 million or more subscribers, and surpassed the high end of its guidance for global HBO Max and HBO subscribers with nearly 74 million subscribers at the end of 2021. John Stankey, we ended 2021 the way we started it, by growing our customer relationships, running our operations more effectively and efficiently, and sharpening our focus. We're at the dawn of a new age of connectivity. Our focus now is to be America's best connectivity provider and ensure our media assets are positioned to grow and truly become a global media distribution leader. So I think that's kind of a good point, and sort of why I think it could be a good thing for them to spin off this business, because sometimes when you just have like so many segments of your business, it can just get clunky and not as efficient, I guess. So I guess what he's kind of saying here is that they're simplifying their business by just focusing on the wireless part of their business and being the best connectivity provider, and then they're just going to spin off the media assets and position them to grow and become a global media distribution leader as that other business. So let's see here. Mobility revenues up 5.1% for the fourth quarter. Operating income of $5.4 billion, which was up 5%. Let's see. So most of their revenues are up at least a little bit, which is good. Warner Media, 13 million new subscribers year over year. Average, I think this $11.15 is average price per user, or average revenue per user per month, probably something like that. So I think that means that on average, everyone paying $11.15 per person per month. So basically that's, $11 times 73 million. So that's close to $1 billion in revenues per month, which is pretty cool. Well, I guess that's domestic. So at that point, it's really only times 46.8 million, but because they don't really list the average price for global subscribers. And they said total revenues up 15.4% in the fourth quarter to $10 billion. So about $10 billion in revenues from Warner Media in the fourth quarter alone, which is pretty good. Let's see. Okay, so they talk about the revenue being a little bit lower this year, but separation of the U.S. video business in the third quarter affected that, and other divested businesses, since these decreases were partially offset by higher revenues in Warner Media and Communications. So if they exclude the impacts of US Video and Vrio from both years, consolidated revenues were 153 billion this year compared to 144 billion last year. So a little bit of an increase there from the businesses that they still own and still are a part of AT&T. So operating expenses down, which is awesome, 145 billion compared to 165 billion last year. They declined due to 14 billion lower non-cash asset impairments, and only having a partial year of US Video and other divested businesses. Depreciation and amortization expenses were $5.7 billion lower, which is thing. Operating income 23 billion compared to 6.4 billion, which is awesome. 13.8% margin versus 3.7%. So I guess excluding, sort of adjusting for both years and excluding US Video and Vrio, the operating income sort of was lower in 2021. So that's definitely not a good thing to see. But net income, the bottom line, is was $19.9 billion this year compared to negative 5.4 last year. So that's definitely really good to see. And adjusting for both years, earnings per share was $3.40 compared to $3.18. So still an increase when taking those adjustments into account. Let's see here. Don't want to go through everything here. We can look at 2022 outlook, because that's pretty interesting. I think the company is planning to host a virtual analyst event in the first half of March. They'll provide additional insight and expectations. They expect the Warner Media transaction to close in the second quarter. So for the full year, they expect revenue growth in the low single digits range, compared to $153 billion. So, if they have 5% revenue growth, that's, I think around $7.5 billion of growth. So that's around $160 billion expected, something like that. Adjusted EPS between $3.10 and $3.15, which is a little bit of a decrease year over year. Gross capital investment in the $24 billion range, and CapEx in the $20 billion range, and free cash flow for 2022 in the $23 billion range. So $23 billion of free cash flow, and forget if their target free cash flow payout ratio is 45% or 55%, honestly. Let me try to look that up. Ryan, what are you saying about the that's why it fell? Because of the decrease in expectations, or the decreases in revenues? I'm not sure which you were talking about. Honestly, they don't look bad. I think the stock, I mean, right now it's at $24 because they were down $2 today, but I don't think $24 is a bad price, honestly. I mean, like, I would be like really excited to buy AT&T probably at like $20, but right now I'm still not really that excited to buy it. Oh, okay. Well, I mean, they have been like there's speculation of the spinoff and dividend cut that's been talked about for a while, and that's been like all that information has been available for a while. I don't think they introduced any new information, did they, about the spinoff and dividend cut? Did they introduce any new information? Dividend. Another thing I don't like to see is it says here net debt increased by $8.7 billion. Which, I mean, that's just not good to see, you know? Like, they just can't have their net debt just keep going up and up. Like, I just don't think that's it's already bad enough, but whatever. Yeah, so dividends paid totaled $15 billion in 2021 for AT&T. And I don't think they're expecting to cut it this year. I don't think that like HBO Max deal is expected to go through this year. Let me see. Uh, I mean, the market was down like a tiny bit today, but it was up most of the day, and AT&T was down like most of the day. I mean, I guess we can look at other companies. Verizon. I guess Verizon was down like 3.5% today. So that's like interesting, I guess. But they released their earnings yesterday morning, it looks like, and T released their earnings this morning, I think. Yeah. Well, honestly, they did like have a pretty good run up there. So I don't know what to expect, honestly, from T and their stock price. I mean, on the one hand, I really expected to stay down probably below like $25. Um, so we'll see. Is it really supposed to go through the end, like before the end of this year? Let's see. It says the deal is expected to close in 2022. So I guess. Yeah, we'll see what happens. Yeah, I'm not sure, honestly. I guess it'll close in 2022, but we'll see how that affects the dividend. So yeah, I guess for now I'll probably just be not doing anything with my shares. Like it would probably take like down to $20 for me to buy more at this point, I think. Um, and just the lack of dividend growth, is just not there. And the lack of dividend growth and growth in the business overall is just like not enough for me to be interested right now. There's just better opportunities out there, honestly, I think. And the new company is probably most likely they don't pay a dividend now, so I don't see them paying a dividend after the spinoff. So honestly, like it's just gonna be you're just gonna get like some cash or shares from that spinoff, and then like a lot of people are probably just gonna sell that cash or shares. But we'll see. Honestly, I might hold those cash or shares if I get any shares. If I get any full shares, I might hold them because that company probably has a lot more growth potential than AT&T at least, but we'll see what happens with that. Other thing I wanted to talk about was just, the overall market, I guess, and how it's looking. Let's see here. So if we look at the market, let me share my screen. Yeah, I did see that dividend increase announcement from Intel, and I also saw that I think the stock was down like a lot today, which is just like, I guess it's kind of expected now at earnings. Oh, I guess it was fine today, but it was down a lot yesterday. I guess that is. Well, anyway, I guess they did report earnings. I'm not sure how their earnings were. Let's look at those Intel earnings real quick, actually, because I would be interested to see what those look like. Honestly, I don't know much about Intel at all, but it is a company that's interesting because of how hated it seems, but how it seems like a pretty decent company too. Let's see. So I guess they reported better than expected earnings, but they provided a mixed outlook. So company $19.5 billion revenues, up 4%, adjusted earnings per share of $1.09, down from $1.48 a year ago. So they beat on revenue and earnings expectations. And it says they did announce a 5% dividend increase. So I guess the CEO is saying the market, like PC market, is growing, and data center market is growing a lot. Um, so they're having the IPO of the Mobile Eye business. I'm not really sure how that's gonna work, but apparently that's supposed to come up sometime soon. I'm trying to look for the expectations, but oh, okay, here we go. So I guess they're setting their expectations of revenues of $18.3 billion, but the consensus estimate was around 17.6, and so I guess they had a lower basically earnings per share expectation for the coming March quarter than most analysts. So I think that's the reason it was down. But overall, just from reading this quick article, it doesn't seem like the earnings were too bad. But I think they, just had those any bit of little negative news just kind of affects Intel a lot, it seems, and just kind of puts them down there and doesn't really treat them favorably. So honestly, I don't know much about Intel, but it doesn't seem like the earnings were really that bad, at least in my opinion. But we'll see where it goes from there. I think that's probably still a pretty decent company overall. And yeah, that's something with Intel as well. They do have a very low payout ratio, and their dividend growth is really not that bad at all, I don't think. Let me look at that real quick. That's definitely let's see. We look at the dividends. Yeah, Seeking Alpha says payout ratio of 23.26%. I guess their dividend growth isn't that great. Sorry. Their dividend growth isn't that that great. It's only at 6%, but that's not terrible. And they've only been growing the dividend for 7 years. So I guess I would say for like a dividend company, it's not that great, but they definitely have potential, like Ryan was saying. And the CEO, I think a lot of people who are sort of in that industry or know a lot about Intel um, are pretty excited for the new CEO and are confident in that. For me, I honestly like. I would say a few years ago, I kind of thought, the CEO of the company doesn't really matter. He's just one guy, and the other people kind of do most of the real work, which is kind of true to some degree. But like when someone's in that position of just like high authority like that, I think that can actually have a lot bigger effect than people realize. Not really, maybe in actually like getting things done. Like that can be one thing a good CEO can do, but also in just like inspiring people within the company and kind of motivating them to work harder or not even work harder, just like bring out the best potential in them possible. That's sort of something that I think like a good CEO and leader can really have a big effect on and really sort of make a big difference that way, it seems. But honestly, I didn't have all that much more to talk about. Like I talked about at the beginning, though, with the income ETFs, I'm definitely the biggest fan of Devo, and Jeppy. I think probably like I think I'd probably like Jeppy the best, but Devo is pretty good as well. And honestly, these ETFs, like income ETFs, are generally better for people that are pretty closer to retirement. They're generally better for people who are, you know, in more of a capital preservation phase instead of capital growth. And so for me, I'm definitely still in that capital growth phase and I'm not really worrying about capital preservation that much. So I'm definitely like biased towards the potential for uh, you know, more capital growth that Jeppy and Devo offers. Oh, Ryan, thanks for hopping on and being a part of the conversation. I do appreciate that. Hope you enjoy that steak dinner. I don't know if you're joking there, but thanks. Hope you have a good night as well. But I think, for some people who are maybe like close to retirement or retired, like they maybe just don't care about that capital preservation as well as much. And so the higher dividend yields of, say, NUSI or QLD are more attractive. And so that works for them. So honestly, I think all these, at least the ones I talked about here, are pretty decent. And, I think they can all work well for different people if, that's sort of what they want to do with it. So overall, I think they're all pretty decent, like I said, but I personally like Devo or Jeppy the best. I was trying to get my parents to invest into Jeppy earlier this year. I think my mom had some money that she said she was looking to do something with, but she ended up just not investing in that, which, is fine. And I think they've done pretty well since we were talking about that earlier this year. But, obviously she's at a different point in life than me. So, you know, my perspective maybe isn't the most relevant. And just because she's definitely focused more on, capital preservation and stuff like that. So, I'm probably about to end the stream here, but I do see that Jack is on here. I just wanted to say hi and thanks for stopping by. I do appreciate that. Definitely don't expect many people to be on today just because I'm don't have a guest and I was just kind of talking about some random stuff. Good to see we have someone else on. So if you do have any questions, let me know, and I'll try to answer those. Or if you want to talk about anything, but aside from that, I'll probably just end the stream here. And want to thank you guys for being here and being a part of it. I do appreciate that. And hopefully we will get another guest on next week and be able to talk more about their specific investing strategies and how they invest and kind of just get a different perspective on investing. So again, thanks for stopping by, and I will see you guys in the next one. Hopefully you stop by the channel again on Saturday to check out the video that will be posted then. So thank you. I'll see you later.